Hi everyone. Hope you're all staying safe and doing well. Welcome to episode 6 of the Foundation series in accounting. In this episode, we will be having a look at accounting for depreciation. Depreciation is a unique procedure in accounting, and it relates to the accrual accounting principle whereby expenses are recorded when resources are consumed or used up. In this episode, we will have a closer look at what exactly is depreciation and why is it needed in the recording of business transactions. We will be examining a couple of methods to calculate depreciation. We will also be looking at how depreciation is reported in the statement of financial position. We will also be clarifying some of the myths and misunderstanding around the concept of depreciation. Let's first have a look at how depreciation is defined. If we were to do a quick search by asking Dr. Google, we will get this definition of depreciation. According to Dr. Google, depreciation is a reduction in the value of an asset over time, and this is due in particular to its wear and tear. This definition of a depreciation implies that it has something to do with the valuation of an asset over time, and this value of the asset will decline due to the process of wear and tear. If we look at the official definition as prescribed by the financial reporting standards, depreciation is the allocation, the systematic allocation of the depreciable amount of an asset over its useful life. It appears that depreciation is a process of allocating the amount of the asset that has been used during its useful life. There's no mention of any attempts to value the asset. Let's look at the definition of depreciation more closely. What assets will require to be depreciated? Why do we need to allocate the depreciable amount of an asset over its useful life? And how will we allocate this amount? The specific group of assets that will require to be depreciated are called property, plant, and equipment. These assets represent rights to physical objects such as motor vehicles, equipments and machines, and buildings and properties. These physical assets are used in the business to generate revenues through the sale of goods and the provision of services over many years. Now, because these assets are used over many years, they are often called fixed assets, and they are classified as non-current assets in the statement of financial position. Let's now have a closer look on the nature of these physical assets. Due to its physical nature, the ability of these assets to generate revenue declines over time. This decline in its utility is due to the wear and tear on the physical parts of these assets from the constant usage over a long period of time. The decline in utility could also be due to the development of new and improved versions of these assets that renders them obsolete. These assets can also become obsolete when the products they produce are no longer in demand by consumers. Therefore, by its nature, these physical assets have a limited useful life. So how does the decline in utility of these assets and its limited useful life affect the recording of business transactions. Let's now have a look at a simple example to illustrate why depreciation is needed. Let's say that we recently decided to buy a truck for our business at a cost of $100,000. And we expect that we will be able to use this truck for the next 5 years to generate revenue for the business. Now, due to its declining utility and its limited useful life, we expect that at the end of its useful life, we would probably be able to sell the truck only for about $5,000. This estimated recoverable amount of the truck at the end of its useful life is called the residual value. So now we can actually calculate the total amount of the truck that would have been consumed over its useful life to be $95,000. This is the difference between the cost that we paid for the truck and its estimated residual value at the end of its useful life. So how much should be reported as an expense for the use of the truck every year so that we can calculate the profits earned from the revenues generated? Since we paid $100,000 for the truck, should we charge out the whole $100,000 as an expense in the first year? But this will mean that there will not be any expenses for the remaining 4 years. This does not reflect the principle of accrual accounting, as the truck will be used in all the 5 years. So to better reflect the resources that are being used to generate revenue, it will be better to allocate the amount of resources consumed over the expected useful life of the asset. This amount allocated over the useful life is called the depreciation expense. Now, the total amount of resources consumed over the useful life is called the depreciable amount. An important point to note here is that the only transaction that involves cash is the purchase of the asset at the beginning of its useful life. The annual depreciation expense does not involve any cash transactions at all and is merely a process of allocating portions of the cost of the asset so that we can better determine the performance of the business every year. So now that we have concluded that depreciation is the process of allocating the resources consumed over the useful life of the physical non-current assets, we need to find out how this allocation should be performed and what are the methods used to calculate the annual depreciation expense. Now, the financial reporting standards do not prescribe any one single method to calculate depreciation. This is because there are so many different types of businesses out there, and there are so many different ways that these physical assets can be used. Instead, the standards provide a principle that should be adopted when deciding on an appropriate method to use. This principle states that the business should use a depreciation method that best reflects how the particular asset will be used to generate revenues. Now, there are many different methods being used in practice. Depending on the nature of the assets, some businesses may use the units of production method, which allocates depreciation based on the number of units of output being produced every year. Now, in most cases, it is not easy to determine how many units of output that would be generated by a particular asset. In such cases, some form of estimation is used. The more common estimation methods used are the straight line and the reducing balance approaches. We will now take a quick look at how these two methods are used. First, let's look at the straight line method, which is the simplest approach. We will refer to our truck example earlier, where the cost of buying the truck was $100,000. The expected residual value at the end of the useful life is $5,000, and the truck is expected to have a useful life of 5 years. Now, this straight line approach assumes that the truck will be used equally for each of the 5 years, and its ability to generate revenue will be assumed to be the same for each year. Now, the annual depreciation expense is determined by taking the estimated amount of the asset that would be consumed, which is the difference between the cost of the truck and its residual value, and dividing it over its useful life. This would be $100,000 less $5,000 divided by 5 years, giving us an annual depreciation expense of $19,000. This would mean that for each of the 5 years of its useful life, the business will charge out an equal amount of depreciation expense of $19,000 for every year. Now, for some assets, the straight line approach may not be appropriate, as the asset may not be used equally throughout its useful life. So let's have a look at the reducing balance method, which assumes that the majority of the utility of the asset occurs in the earlier years of its useful life. Therefore, this method results in a decreasing depreciation charge over the useful life of the asset. Now, using the same truck example, the depreciation expense will require a more extended calculation and has to be done separately for each year of its useful life. We will begin with the first year and start with the cost of purchasing the truck of $100,000. We will need to multiply this amount with a predetermined annual rate of depreciation, which is calculated using this formula. That is made up of the residual value and the cost of the asset. N is the estimated useful life of the truck. Now, solving this formula will give us a rate of 45%, which is then multiplied with the starting amount for the year of $100,000. This will give us $45,000, which will be the estimated amount of the asset used or the depreciation expense for the first year. Now, the balance of $55,000 represents the unutilized portion of the asset after the first year. Now, in the second year, the starting balance represents the unutilized portion of the asset from the previous year. And this will be multiplied by the same predetermined rate of 45%. The resulting amount of $24,750 will be the depreciation expense for the second year, and the remaining amount of $30,250 represents the unutilized portion of the asset at the end of the second year. Now, this calculation is then repeated for the next 3 years of the useful life of the asset. Note that at the end of the useful life, the balance is close to the residual value of the asset, which we assume will be recovered through the disposal of the asset at the end of its useful life. Now, as you can see, the annual depreciation expense using the reducing balance method shows a declining amount over the useful life of the asset. This method is appropriate if we assume that the asset's utility is higher in the earlier years compared to its later years. We now have examined why depreciation is needed in recording business transactions. We have also examined some of the common methods used in the calculation of annual depreciation. Let's now have a look at how depreciation is reported in the statement of financial position. We will use our truck example and assume that we are preparing our report 2 years after purchasing the truck. As mentioned earlier, depreciation is related to property, plant, and equipment, which are classified as non-current assets in the statement of financial position. The truck that we use as an example is normally classified as motor vehicles. Now, the cost of acquiring the motor vehicle is reported separately so that we can keep track of the asset over its useful life. Now, the amount of depreciation charged for the use of this asset is recorded in a separate account called the accumulated depreciation. Now, in our example where we use the straight line method, we have used up a total of $38,000 after 2 years, which is at $19,000 per year. Now, the unutilized portion of the asset is called the net book value or the carrying amount, which in this case is $62,000. Now, if we use the reducing balance method, the cost of the motor vehicle of $100,000 will be reported in the same manner. But under the reducing balance method, the accumulated depreciation for the 2 years will now be $69,750, which is $45,000 in the first year and $24,750 in the second year. Now, this is much more than using the straight line method because of the assumption that the utility of the asset is higher in the earlier years. Now, under the reducing balance method, the unutilized portion of the asset or the net book value will now be $30,250. Therefore, depending on how depreciation is calculated, there will be an effect on the amount of assets reported in the statement of financial position. Now that we have had a better understanding of what is depreciation and how it is calculated and reported, let's now clarify some of the common misunderstandings around this concept. Now, many people have assumed that the amount of accumulated depreciation represents a reserve of cash that can be used for the replacement of this asset in later years. We have already concluded that depreciation has nothing to do with cash flow. Depreciation is a non-cash item, and the accumulated depreciation does not provide any cash reserve that can be used use in later years. If we really need cash for the replacement of assets in the future, these cash need to be separately set aside. Another myth about depreciation is that it is part of a valuation process. Now, depreciation is not a valuation process. It is a process of allocating the amount of asset used over its useful life. I hope you now have a better understanding of what depreciation is all about. I hope this video has been able to play a small role in alleviating any sufferings that you may have encountered when dealing with the accounting for depreciation. Please do like and share this video. Please do subscribe to my channel and remember to click on the bell icon to be notified of new videos that I will be releasing in the future. So till we meet again, please do take care and stay safe.